All right. Well, hello, everyone. Thank you so much for joining us. We're excited to have you and our speakers today, Nate Tu and Mike Anderson. They're going to be talking to us today about the 1031 exchange process and just educating us more on the ins and outs, how they can benefit investors and important mistakes to avoid, et cetera, et cetera. It's going to be super great. We're really excited. I'll quickly introduce myself and our company, Keyrenter, so we can get started. My name is Ryland. I'm the Client Success Manager here. I get to do a lot of the sales and networking for our company, so I may have seen some of you on other webinars or events. It's good to see some of your names here. We also have Nate Tu here, who is our Keyrenter president. He's commonly known in our sphere as the video guy. You may have seen some of them. He makes some awesome educational videos about real estate and property management, and always does his best to educate the community so we can all reap the benefits of real estate. And of course, that's one of his many, many, many things that he contributes to the real estate space. Just to give you a little bit about Keyrenter, we offer a full property management solution to residential property owners in Salt Lake. So our service are for people who believe in high value property management as the vehicle to growing wealth through real estate. That's what we're all about. We focus on those who want a passive and successful rental property and a positive experience for themselves and their residents. And our promise to those who use our services is that you will get a stress-free investment with no surprises. Now on to Mike here. He's so awesome. We're so glad he's with us today. He's the Director of Exchange Services for Zions Band Corporation and President of Exchange Services, LLC, which is just a 1031 exchange qualified intermediary service company that serves Zion's 8 affiliate banks throughout the Western US. He's a frequent speaker and author on exchange topics and is a certified instructor for continuing education for attorney, CPA, and real estate licenses. So needless to say, he's definitely the expert. We're super excited to learn all we can today. As you can see, we have all of our contact info on the screen. So if you guys want to take that down, feel free to reach out to any of us if there's anything we can do for you after this webinar, and we'd love to connect with you. Before we hop right in, let's just set some expectations. So first, for the sake of everyone's sanity, we'll keep everyone muted besides Nate and Mike, but we would love to invite you to ask questions as you have them in the chat box, and we'll be answering those at the end during our Q&A segment. We'll do our best to answer as many of your questions as possible during that time. To kick this off, let's make sure that the chat's working here. So everyone that's here, can you chime in the chat box and just let us know what city you're joining us from? Own a property.
Very cool.
Cool. Awesome. Thank you. It's so good to see you guys and what you're up to and what brought you here. So feel free to utilize this chat throughout the webinar to get to know each other or for just general comments throughout this webinar. And as I mentioned before, you can submit questions throughout. I'll keep track of those and send those over to Mike to make sure we get those addressed during the Q&A segment. But for now, I'm going to turn the time over to Mike and Nate. Are you guys ready to go?
Yeah,
I'm
for
ready.
sure. Yeah, thanks, Ryland.
All right,
Ryland and Nate, thanks for letting me be part of this with you today.
Yeah, welcome, Mike. And if you guys didn't have a chance to jot down our contact info, we can show that again at the end. If you have any other questions after the webinar, feel free to reach out. We're happy to help out with any questions you have. But yeah, thanks, Ryland. So it's great to be with everyone. And Mike, it's great to be with you today. We want to really provide value through these workshops for our clients, the realtor community, landlord community, and really help everybody grow, improve together as investors. That's a really important thing for us. Thank you, Mike, again for joining on. This is sometimes a technical and a tricky topic. And, it's something that oftentimes our clients have reached out with some technical questions. And it's great to have a resource like you to really help people prepare. And I think that's one of the important elements is preparing for the future, right? 1031 exchanges is something we can't just immediately just say, okay, I'm going to do this tomorrow. We got to be prepared. And before we dive into the details of this topic, Mike, tell us a little bit about yourself, your role, and what you do, so we have some context for this discussion. I know Ryland gave you a great intro, but just share from your perspective some of what you do day to day to help us through this process.
Well, day to day, I talk with investors and title company escrow officers and real estate agents and attorneys and CPAs, talking about what people want to do, where they are, what their goals are, and my job is to try and align their goals with tax regulation, and that's kind of fun sometimes. Sometimes it's tricky, but I never know what's going to happen in any particular day or time. Phone calls come in, people call up, we have emails. We have questions, and it's fun to try and fix them, help them get fixed up. I enjoy working with a sturdy, reliable platform with Zions Bank, and so it's nice to have that behind me. So, yep, that's
Awesome.
what I do.
Very cool. And I want to start out, you guys, by polling the group. So I want to ask a question to everybody. I'm going to launch a poll here in just a second, just to get an understanding. So Mike and I, as we're having this discussion, we can have a good understanding of where we're all at in our knowledge of 1031 exchanges. So I'm going to put this poll out here. We've got right now 69%. This is kind of moving. You can see 66% have heard of them, but not very knowledgeable. We've got 6% who are very familiar, 18% are familiar, and 6% have never heard of this. So it's great for those who have never even heard of this concept, but you can recognize that this can be important for you in your real estate portfolio, your real estate goals. And so knowing that, Mike, you can kind of see where the majority of people are at here. And I'm going to go ahead and end the poll, and we'll start our discussion here. And I think that a really great place to start is really just giving us, if you could, Mike, a brief overview of what a 1031 exchange is. And then you can talk about some of the benefits of an exchange, and maybe if there's any drawbacks or any reasons people wouldn't want to do an exchange. But share just kind of that general overview. That'd be really helpful.
Well, my elevator speech is we help people defer capital gains tax when they change their property investments. That's kind of what we do. We use section 1031 or 1031 of the tax code to help people defer their capital gains tax. You don't eliminate the capital gains tax, you just put it off. I'll think about my son who, one of my sons, I have 6 kids, but one of them had trouble getting up in the morning and making his bed. And so he would get up in the morning and as late as possible, slip out of bed, get off to school, and he would say, "I'll make my bed at night. Tonight, Mom." And then, of course, tonight he wouldn't. That night he wouldn't do it, and he would defer making his bed. And that's what my customers want to do about their tax. They want to just put it off as long as possible, and that's what we try to help them do. And that helps them, lets them keep their money at work for them. So instead of paying a third or 10 or 15 or 20% of the value of your property that you sell in taxes, that money is put back on the table, reinvested in the new properties, and it's making more money for you. So that's what we do. On a day-to-day basis, what we do is we talk with customers who call and they say, "I've got a duplex, I've got this apartment complex, I have this farm, I want to change this and get something else. How do I do that?" And so we talk with them about the documentation required. We talk to them about what the deadlines are, and then we help them ask particular questions about whether the vesting is correct or whether the property is properly used and so forth. Then we work them through the process and get some documentation for them. We send the documents to the title company. They go to the title company, or they close with the title company. I see Christian Higbee up there from Cottonwood Title. We love working with these great title companies like Cottonwood Title. And then at the closing, the escrow officer goes through that process. They close the transaction. The money comes to us, and they get 45 days to identify property, 180 days to close it, and then we go through that process again and send some money out to the closing, and that's how it goes.
Very cool. You went through quite a bit there, and that's awesome. And I think we'll unpack that as we go through our discussion here.
Okay.
One of the questions that was brought into the chat was, they deal a lot with commercial real estate. Is the process the same for residential as it is for commercial? Is the tax code the same? I mean, the basic fundamentals of an exchange, does that transcend the type of real estate asset that we have?
Yeah, it doesn't matter to the IRS whether it's commercial or residential or agricultural or healthcare or hospitality. It's all the same rules.
So a
They
lot
get,
of what, oh, continue, sorry.
well, they hit each one a little bit differently. They're different little issues to worry about, but in general, that's the same stuff.
Okay, so a lot of what we're sharing today and what you're going to be discussing, someone who's dealing a lot in, restaurant or commercial or residential, they can take a lot of this, to practice, and then as they start preparing for 1031 exchange, they'll be able to implement some of what we're discussing, and then of course get in touch with you to help facilitate the exchange.
Great. Okay.
Okay, so let's dive in here and talk a little bit more. Are there any reasons why someone would not want to do a 1031 exchange, or any drawbacks to that process?
You might feel like the market is too high. You want to take some money out of the real estate market and put it into the stock market or into gold or something like that. You may feel like real estate has had its day, but you have to realize in doing so you'll pay tax, and so you have to think about whether the property or the investment you would have that's an alternative to real estate has enough return to match what you would get out of real estate, plus pay back the tax you'd have to pay.
So doing a little calculation to understand, okay, if I take out this cash today, my capital gains rate is X and I need to pay that capital gains. Is my return by keeping this in a real estate vehicle going to exceed what else I could do with that money, whether it's invested in other types of asset classes or different things to maybe get a higher return that could compensate for the capital gains tax that we received? Is that one way of saying?
That's right.
No.
Another thing is that real estate is somewhat illiquid compared to stock. I mean, if you have stock, you can call your broker, and your broker can sell it and be done. But for a while, it takes usually a couple of weeks, maybe a couple of months to get something sold, and similarly to buy a new. So it's a slower process as well.
Now, one of the questions that I've gotten before is, can I sell my property, my rental property in real estate, and exchange it for gold or exchange it for some other type of commodity, not necessarily stocks and bonds, but some other type of tangible commodity? Can that be done?
Well, if it's when you say there's one phrase you hear a lot in 1031 exchanges is like kind, and so to do an exchange has to be like kind property, and today that means real estate. So if you do an exchange out of some kind of real estate and some other kind of real estate, you're eligible for an exchange. If you sell out of real estate and you want to buy a houseboat, if you want to buy rolling stock, if you want to buy gold, that's all not like kind, and then you pay tax in that process.
Got it. But it could be residential for commercial, multifamily for a single family. It can be anything that's like kind in real estate.
And so you can sell your duplex and buy a shopping center. You can sell your shopping center and buy a farm. You can sell a farm and buy a railroad right of way. All those things are possible. Even a lease on real estate that lasts more than 30 years is by the IRS like kind to real estate ownership.
Now, I appreciate that. Another question that I've gotten often is, okay, if I've got, say, 200 grand in gains here, and I want to put that into a property where, the ticket is much more. Can I put that gain into a property, but then cover the difference with a loan or with cash, or
Yes.
how does that process work?
Well, so in general,
kind of upgrading that property, right?
To defer capital gains tax, the new property or properties together have to equal or exceed the property you relinquish in value and in equity. So most of the time, our customers end up paying at least a little bit more than what they've sold for. And well, the purpose of 1031 was to help encourage continuity of investment, is how the Congress put it, meaning they want to have you keep invested, your assets invested in the market, in the economy, and generating activity for everybody. And so if you sell something for $500,000 and buy something for $1 million, the purpose is accomplished. And that's encouraged by the way the regulations are written.
So again, so if I were to try and upgrade that property, is it possible to cover the difference with some kind of seller financing, with a loan? Does it have to be non-recourse loan, or how does someone go about upgrading? They can just roll that in and cover the difference however they can.
Often you're paying off a loan when you close the sale. And so if you sell for $500,000, you may pay off a $200,000 loan. Then you go buy a new property, say for $600,000, and you take your $300,000 of cash and put that down. And so you put 50% down, you borrow the other $300,000, and you're off to the races. Or you can bring in $300,000 out of your piggy bank, or you can do seller financing for that $300,000. It doesn't really matter in terms of the regulations.
That's great that's great to know, because I've had a lot of people in the past say, when you do a 1031 exchange, you have to come in with all cash, or it needs to be whatever your gains were can't be less than the acquisition price. And obviously that's just wrong information that's getting passed around out there.
Well, if you buy a property for $200,000 and it appreciates to $300,000, and you want to defer all the tax, you have to buy another property worth at least $300,000. So it's not a way to pay off debt. It's a way to invest in the economy.
It can be above, it just can't be below. So I couldn't take $200,000 in gains and buy a property for $100,000 and expect to not have to pay taxes on the gains that I took out.
You're right. So if you sell for $500 and buy for $400, you have $100,000. The difference is $100,000. That's called boot, which is the way we talk in our industry is it's potential real estate gains to be taxed. And if your gain, and so you'd pay tax on $100,000 if you had at least that much in gains.
Got it. Okay.
Situation.
So you can take a portion of your gains, reinvest that, pay taxes on the difference.
I had a person today tell me he was going to have $600 left over when he got through buying his new property, and I said, "Well, you probably pay tax, and something like $200." And he was okay with that, but that's sometimes that happens. You can't get that close.
So do you and your team help people do you look at their specific scenario and help them understand what the potential for their specific investment exchange would be? I mean, obviously they want to talk to their accountant, right, when it comes to their specific tax implications, but it sounds like your team has a pretty hands-on approach with people that are preparing for this process. Is that right?
Yeah, so we can't give tax advice, but we try to say, well, this question here that you've asked me is in the gray area in your situation, so you need to talk with your tax advisor. But we can say, this is how this goes. This is the settled law in the process, and you can take it from there. But that's our job, basically. Someone says, I've got a duplex. I want to sell that. I've got a farm in Idaho. I've got a hotel in San Diego. I've got how do I do this? I've got 3 people that own this property. How do we deal with that? And those are all the things we deal with all day long. And so because we do it enough, we kind of learn the answers to questions, and we hopefully get better at it as we go along.
So let's talk a little bit more about the fundamentals and the process of these exchanges. And I know you gave an overview, but I want to go a little bit deeper on how would someone get started with the process? Let's say they want to sell their property. They're looking into an exchange. Do they talk to their realtor about that? Do they talk to the title company? How do they just kind of get the wheels in motion to get that rolling?
Well, when you can talk to us before you get ready to sell, we can talk about some structures and some ownership issues, which are often better served before you get too far into it. But you talk to your title company, you talk to your real estate agent, but somewhere at some point you have to be introduced to somebody like us, the qualified intermediary, and at that point we have a discussion. We try and qualify it. Does this make sense for you? Does it not make sense? Is it something that we can do? And so then in that process, then if you're ready to go, we'll say, do you have a contract with a buyer? And then if you do, then we'll say, do you have an open escrow at a title company? And then we'll get a hold of that title company escrow officer and say, I would like to have a copy of the title report and the contract for Nate's exchange. And we'll get those and we'll identify the property, we'll identify who the owner is. We'll use that information to create the documents that talk about the property and the taxpayer that's involved. And there's a set of documents. We can talk about what they are, but those documents convert the sale into an exchange relinquishment and directs the title company to send the money to us and gives us the right to hold the money for them and creates the trust for us. And that's where we start. And then at the closing, you figure out where the money goes, whether the settlement statement is all correct. And then they send us the money and we get those and we open an account, we put the money in the account, and we send you back a letter that says, hey, we got your money, we got $283,000 whatever dollars, and we think the closing date was August 27th, and so your 45th day is this date, and the 180th day is that date, and so we say, and here's the identification form, go to work, go find your property, and we'll talk, and that's where we get started.
And you talked about the dates. You know, this is something where it's important that we understand these dates. From what I understand with exchanges, we've got to understand these dates. Let's go through those dates, those deadlines that we have with an exchange. Why don't you start with the first one? And Ryland, if you can put this in the chat, just so we have it in writing and people can put it in their notes too. What are those deadlines that we have with an exchange?
Well, to me, the easiest way to avoid heartburn and to have a good experience in an exchange is to do the identification correctly and promptly. So you have 45 days from the date of the sale to identify finally in writing and deliver to us a list of the properties you want to identify. And usually that's 1 or 2 or 3 properties. And it's a really good idea to get one of those under contract in those 45 days. You don't have to, but it's a really good idea because if you get to the 50th day, you've identified a property on the 45th day, and now you're on day 50, and you don't want to buy that property because all of a sudden there's it's a meth house or something, and you don't want to buy it. Well, you can't take it off your list. So the first 45 days is really the most crucial time. You do a lot of searching, do a contract if you can. Do your inspections if you can. So by day 45, you say, I've got a contract, I have a property I like, I've inspected it, I want to go with it.
Is it important? So you need to have that under contract within that 45 days, not just a list of properties. Is that what I'm understanding?
Well, you don't have to, but it's a good practice because, if all of a sudden the property goes away, somebody else buys it out from under you on day 50, you're out of luck.
So it's day 46. What do we do if we don't have that property dialed in and selected?
On day 46, if you haven't given us that list, then your exchange closes and we send you the money back.
And so at that point,
you pay tax.
You pay tax. Got it. So those dates, I would imagine that's one of the challenges that people run into, and one of the biggest pitfalls is not keeping track of these dates and understanding how important they are. So that's the 45 days. So selection. Go ahead.
So a closing is kind of a big deal, and so often you have to get through with it. On closings are great. I want to take some time off. I want to go to Paris or to Paris, Idaho, or Paris, France, have a vacation and come back. And so a week later, you come back and your 45 days is now 38 days, and you go through all your mail, and all of a sudden it's 31 days, and oh my goodness, I don't know what to do. And so you have to work really hard. And we get lots of people calling us we try and get back to our customers on day 35 and say, how's it going? Do you have anything ready to go? And sometimes they say, I don't know what to do. I don't know what to do. And so we start trying to figure out how we can help them find something anyway. So, but that's kind of the tricky part, is to get the identification done, because once you've got the property under contract and you know you want to buy it, then you can move to close, and it makes more sense. I mean, it makes life a lot easier.
And Mariella asked here, so if we found a property and then for some reason it falls off, let's say they go through the due diligence process and decide, gosh, this is not going to work out, like we need to pick a different property. What options do we have at that point?
Well, it depends on when this happens. If it happens on day 15, then you go keep looking. If this happens on day 47, you can't change your list. So hopefully, if one gets sold out from under you, one idea is to buy it from the person that bought it, but that's not going to be very fun. So what you hope is that you have another property on your list that can replace that. So you can have a backup on your list, and maybe, but in a market like this, it's hard to have backups sit still for you. So I go back to my previous comment: is get it under contract, get it inspected, and nail it down
Quickly. Yeah. Now, is there a limit to how many properties can be on that list?
Well, there are a bunch of rules for that. The first rule, the most commonly used rule for 90% of our customers, is any 3 properties of any value.
3. Okay.
And that, if you're selling one property and buying one, that usually works. I had one customer that sold a $75 million property, and they bought 15 properties. And so they use a second rule, which is called the 200% rule. You can identify, if 3 properties isn't enough, then you can identify any number of properties whose combined value is less than twice the value of the property you sold. So in this case, he had $75 million. He had $150 million to buy 15 properties. So he could buy a lot of properties, but they were still and that one was a lot of work, because we had to do it within 180 days. And it was the end of the 180 days. The last day we did 3 closings for him, and it was kind of hairy there, but it worked out. But
and so just to reiterate, this 45 days, when does that start exactly? Is that the day of recording? And is that day 1, or is that day 0, and then the next day is day 1?
Well, it's the date of the IRS says it's the date the burdens and benefits of ownership transfer.
Okay.
And for 90% of the time in Utah, in most cases, it's recording date. But there are times when the transfer occurs. Other times, I could tell you a couple of nightmare stories about why people kind of didn't get that straight. But that's the story. It's the date of transfer, and that's day 0. Then the next day is day 1, and then day 4.
Okay.
And it has to be midnight on the day on the 45th day. And here's a funny story. I was coming home from a movie at 11 o'clock at night, and I had a client in California send me an identification form, and it came on my email at 11:15. No, excuse me, at 12:15. And he said, "Mike, I'm sorry I'm late." He called me, and I called him back, and I said, it's kind of midnight, and and he said, "You missed it. I'm sorry to say." He said, "But I'm in California." And he said, "So, okay, it's not midnight yet in California. Is that where you sold the property?" And I don't know. I'm trying to figure out and he said, "Well, yeah, it was." And so I said, "I guess it counts where you did it." So we accepted that, and his CPA agreed with us. But we don't recommend waiting till the last hour before midnight. I would say get it to us a day or two early. We can see if you've done it correctly. So another part of that is the property has to be unambiguously identified, and so it has to be signed and in writing. So sometimes we say, "I'm going to buy a condo in Country Springs, the Springs at Country Woods." well, there are 200 condos there, 300 condos there. And I called the fellow back and I said, so you've identified, you have to be more specific. And they said, well, I don't know which one I want to buy. I said, well, you got to know. You have to decide.
Yeah, pick
And
the
he said,
unit
well,
and yeah.
yeah. And so he scrambled around and he figured it out. And so, yeah, that's my life, is helping people through these processes. Yeah.
Very good. So 45 days to identify. Let's kind of outline the next deadline. So 45 days to identify, and then once it's identified and we're in that 46th day, what is the next deadline and what needs to be done during that period of time?
Well, you can close on the property anytime during the exchange period, but the deadline for acquiring property is the 180th day from the closing
Okay.
from the transfer of the sale. And so, and if you think about it, how do you close? Well, usually it's recording, and that doesn't happen very easily on Saturday and Sunday. So what you really want to do is you want to figure out 180th day. Is it a Saturday? Is it a Sunday? Or is it a holiday? And if so, we have to kind of back up our deadline to the last business day before that. And for heaven's sakes, let's do it, a week before the 180th deadline, because as we all know, closings sometimes move, they slip, and something doesn't happen. And so you want to give yourself a little cushion so that you're not slamming up against the wall if anything happens.
The 180 days then is not tied to the 45 days. It's just you have 180 days from that date of closing, recording on the sale, to finalize the closing and the recording
Yes.
of that property. So if you settle, a lot of people call going to the title company and signing docs closing, but that's not closing. That's actually settlement. And closing sometimes doesn't happen for a day or two after that. Have you had that happen where they signed on the 180th day, but the buyer's funds, weren't available for settlement or for recording until a day or two after that deadline? And how does that work?
Well, so part of our responsibility is to get the money to the closing. And so an important part of our job is to keep track, help with our customers, and sometimes we're really pushing hard. And luckily we're a bank and we have very good access to the Federal Reserve System to wire them funds. But at some point, the curtain comes down and you can't wire, and we've had to do some other stuff. So everything you can think about's happened, plus some things that you haven't thought about, and every day is a little different. But so we try really hard to help get our customers to be closing on time and being ready early, and get our wiring instructions so that we get it in and so forth. And that's the work. That's our job.
Awesome. So any other deadlines there? We've got 45 days and 180 days. Anything else that people need to note in terms of timeline? Well,
here's some more arcane things. If you sell your property after October 17th, any particular year, your 180th day is after April 15th. And so one of the questions people ask is, well, do I have to do it by year end? Because one of the rules is that you have to report the exchange on one tax return, both the sale and the purchase. So if you were to sell, say, on November 1st and send your tax return in on April 1st, or let's say, on April 1st, let me say March 1st, then your exchange would be over. But you didn't report, but you haven't purchased property, so you would fail. And so what you really want to do is make sure that if you sell after October 17th, that you on April 15th, you file an extension, and so you get your full 180 days and can get it in. So that's one of the things we also talk about. And in fact, there's also some extensions that are available for people who've been affected by natural disasters, like the fires that are going on in California right now. We got a notice from the IRS a couple of days ago that they're going to give them 120 days extra if you were affected by that certain ways. And that unusual storm in Iowa has that.
Mm-hmm.
And the biggest one was back in April. The IRS gave everybody an extension if your deadlines were after April 1st until July 15th because of the COVID-19 disaster, if you
Right.
will. So July
Right.
15th was a real busy day for us
I'm
because
sure.
yeah, we had lots of stuff going on.
I'm
So
sure. Did you take
help
a
us.
week off after that?
That would have been a good idea, but good. So that's what's come the deadline stuff we have to deal with.
Good. Thank you. I want to talk just for a few minutes before we go into some Q&A about entity structure, because I know that that can be really important in terms of if I'm selling in my personal name, but I want to buy it with a partnership. I've seen a lot of people run into some of those challenges of entity structure, or I should say more on the tax side. So maybe share some of your insight on how we need to have our properties structured with the entity or the tax entity when we're doing that sale and we're doing the exchange.
That's a very good question. I'm glad to talk about it. So if you think about it, we get tempted to do things and kind of say, well, my wife and I are the same person, or we're related, or so, or we're in a group together. But the real concern is, the rule is, the same taxpayer must both relinquish and acquire property, which makes sense if you think about it. But if you're in an LLC, for example, and the LLC has 3 members, and you go to the closing and you sell the property, well, maybe member A wants to be a part of it, member B doesn't want it, member C wants to do an exchange, but not with you anymore. Sometimes partnerships kind of are tired by the time they get through the deal, and so that causes a problem, because if you're in an LLC as a member, you don't own the real estate. You own the LLC, and the LLC owns the real estate, and the LLC is the taxpayer. So if the LLC sells property, then the LLC has to buy property. And so that, if you want to break it up, then that's where we get a little bit of trickiness, because the property held in an exchange for an exchange has to be held for investment, not for resale. And so distributions on the day of the closing, where you break up an LLC and say, if you and I and Ryland run an LLC together, we decide we want to go different ways, and we deed from our LLC to each of us on the morning of the exchange of the sale, and then we each go different ways. It's hard to argue that I, Mike, owned the property for 2 hours, but I held it for investment and not for resale. Because so what you want to do, if at all possible, is to identify before you close before you do a contract, if you're an LLC, that do we want to do this together? Do we want to go it separately? In which case, if you want to go separately, you talk to your CPA and do a distribution. If the CPA wants to help you do that, and then you sign the contract either a year ahead of time or whatever, as the 3 individuals, as Nate and Mike and Ryland, instead of the LLC. And then that's consistent. Then you do what you want to on your tax return, and I do what I want to on mine, and Ryland does what she wants to on hers. So that's an important thing.
Yeah. And so let's say, just for example's sake, so if I own a property in an LLC, okay, and I want to exchange that into and that's just a sole member, limited liability company, LLC, and I want to exchange that into a property. Say I want to upgrade, but I want to do it with some partners. Is that possible, and how would I go about doing that?
Well, so here's this is a little different case than what I just talked about, because there's a special case for an LLC with 1 member. And in general, an LLC with 1 member is like a partnership with 1 partner. It's not a partnership anymore. It's really a single proprietorship. And so if it's Nate LLC that owns the property and Nate's the only member, then Nate LLC can buy the property, or it can be Nate by yourself can buy it, and in your name, if the banks like that better, which is often the case. But also,
and that's because it's the taxes flow to me personally. And that's
Right.
why it's because I'm taxed. But if I'm buying that say it's a complex and there's 4 other partners, and I want to try to exchange that single family house into that partnership, is there any way of doing that?
Well, you cannot buy partnership interests in
Okay.
with exchange money. That's black letter law. Often, though, people will buy, say, a tenant in common interest, where Nate will buy a 33% undivided interest in the property, and somebody else will buy 22, and somebody else will buy 45% or something like that. And that's one way to solve that problem. There's another thing called a Delaware Statutory Trust, which is a
Yep.
popular vehicle today for investing with groups. And if a Delaware Statutory Trust can be a private deal, but often they are associated with a sponsor that will arrange the transaction and create the trust, and they would buy a beneficial interest in the trust, and the IRS, because the specific structure of those trusts, IRS recognizes that interest in the trust as being like kind to real estate.
Good. So as long as all the other investors are okay with a TIC or going through a syndication and set up it as a Delaware statutory, then it's possible. And that's good to know, because I have heard from various people that no, you can't do that. There's not a way of structuring that. So that's great to clarify that from the
But you're right. You cannot buy an interest in a partnership. So
partnership. Yep. Good.
So they feel the same in many ways, but the specific differences that are important for us.
Very cool. So I want to talk just for a minute, vacation housing, short-term rentals, where we've got this, it's not quite, it's an investment property, but I actually like being there with my own family, right? And I want to use that property for my own personal use as well as investment use. How does that work? Is that, in terms of that safe harbor that we hear about with those exchanges?
Well, the interesting thing is the IRS says the property has to be held primarily for business or investment purposes. Doesn't mean solely. And so the law allows for, or the regulations allow for, a little bit of personal use. And you can imagine over the years, since 1921, when this was put in the tax code, there's been a lot of discussion between the IRS and taxpayers and tax professionals. Well, how much is primarily, and how little can I do? And there's been no guidance other than some decisions like Clarkowski, where for commercial properties, where they say it's kind of the facts and circumstances. I'll know it when I see it, the judge says almost. But luckily for dwelling units, the IRS has issued a revenue procedure that tells the world, the U.S., how they're going to look at certain things. Revenue procedure include in this case what they call a safe harbor, which means if you follow these guidance and this guidelines in this safe harbor, you'll be safe. And so they issued a safe harbor to help all of us, including the IRS and the rest of us, to kind of know what can we do to be safe. You don't have to, but you can. And so the guidelines are a little bit technical, as they seem to be with the IRS, but it says this applies to both the holding of a property before you sell and holding of a property after you purchase, either case. And so what they say is, they say 2 12-month periods, and you as the owner of the property need to rent it out to someone who's not your relative, not your related party, for at least 2 weeks in each of those 2 12-month periods, which seems quite generous to me. They also say that you can use it yourself personally less than 2 weeks or 15 days, or 10% of the time it's rented to somebody else. And so if you rent it out 100 days, you get 15 days. If you rent it out 200 days, you get 20 days. If you rent it out 300 days, you get 30 days. And so you could imagine, say it's a Deer Valley condo, you could have a week during Sundance and a week during the holidays, That's your 2 weeks. You could use it yourself those 2 weeks and then rent it out for 2 weeks, at least the rest of the year. Now, if you have a Deer Valley condo and it's used 4 weeks out of the year, you're probably underutilizing it. But those are the minimums or the maximums. But you'd want to rent it out more than 2 weeks if you could. But those are the rules. And then after those 2 years, if you do the 2 years right, after those 2 years or before those 2 years, if you're doing a sale, if you do it right, then you're safe. And if you don't do it in the 3rd year, you may not have the performance you want in the 3rd year, but at least you've got your exchange defended. And so that's the rule, and it's nice. And so that would also work if you said, "Gosh, I really like this thing at Deer Valley. I want to move in full time." Well, if you did the 2 years, 2 weeks thing on year 3, if you can move into it, make it your personal residence. Now, you can't go into it with that as a definitive plan, but yes, you could in year 3 or 4 or 5 to say, "Hey, I like this. I'm going to move in and stop the rental thing," and that would be fine.
That's so good to know. I mean, there's so many folks out there with Airbnb rentals and vacation rentals, and I just wonder how many are really thinking about that ratio, right? And understanding, because in most of our minds, if we have this property, we're not living in it as a primary residence, then it should just qualify for an exchange. But if we go over that ratio of 10%, or it's not rented out enough to an actual tenant, we could be stuck trying to do an exchange and, needing to pay taxes. So that's really good to know.
One of my clients was facing that, and he said, "Okay, what I'll do is I'll buy 4 smaller properties. And that way he gets 2 weeks to each of the 4, and so he has 8 weeks." And that's that's what he wanted to do out of that process. So
awesome. Well, very good. Hey, well, we're going to jump now into some Q&A, and Ryland, if you want to jump back in here. And I know we got some questions that came in through the registration process. We probably have time for 4 or 5 different questions. And then if anyone else has, I know we've got a few questions that have come through the chat, and let's dive in.
Cool.
You're muted.
Well,
there we go.
Oh, I am. Oh, okay. Perfect. Okay. So a few of you, as Nate mentioned, submitted questions beforehand. So we'll start off with those. First things first, can a 1031 exchange delay a real estate transaction?
Well, I'm not sure exactly what that means, but I think it might be that, well, what happens if I try to do an exchange? Would it slow my closing? Would I have to extend the closing? And it really shouldn't. If you call us when you're at the closing table and you say, "Can I do an exchange now?" It might take us a couple hours if we can squeeze in that day. But in general, I would think that if you give us a reasonable time, we can get it done. And we try and get them done the same day. So I think usually it shouldn't have to be shouldn't delay the exchange transaction. Sometimes we bring up issues like the ones you talked about with the LLC that we have to kind of work through, which might be part of that. But in general, shouldn't delay a real estate transaction.
Okay, good to know. Next question here, can a partial exchange and partial cash out be done? For example, 625 grand, commercial building with 175 mortgage, equity of 410, after closing costs in exchange for 300 rental home and cash out 110, tax implications also. Thanks. Sorry, I hope that made sense. If you need me to repeat it, let me know.
Well, in general, what happens if you go down in value, you'll pay tax, you'll recognize gain, or boot, I should say, on the difference between your higher sale price and your lower purchase value. And so that difference is called boot, and to the extent that you have gain that's equal to that boot, you'll pay tax. And so what you hope to do in that situation, if you have a boot of $110,000, you hope that your gain is more than $110,000, so you still get some benefit from the exchange. If your gain is $110,000 or less, then there's no benefit from doing an exchange. You probably shouldn't do it, or think about how you might want to get your cash some other way. So you can do it. It can be thought to be expensive, but if you have a good use for the money, that's what some people want to do.
Nice. That's your prerogative. Cool. All right, let's see. We've got another question here. It doesn't need to be like for like, or can I exchange a rental house for land?
Well, like is a relative term, and so if you live in a duplex or in a single family home, you might feel like they're different. But so the definition of like kind to the IRS is it has to be real estate, and so you can sell a rental house and buy land. You can sell land and buy a shopping center or other stuff. And so as long as it's real property held primarily for the right purpose, it's like kind to the IRS as foreign exchange.
Okay.
Hey, Ryland, we got a couple. There's one question here I really want to answer or have Mike answer. Is there any way? This is from Scott. Thanks, Scott, for jumping in here. Is there any way for an owner to offer seller financing and still do a 1031 exchange?
Theoretically, yes. It's tricky because the IRS considers the note that's created with seller financing when this is a situation where the taxpayer is doing the seller financing. Now, if you were to buy a property using the seller's seller financing as part of an exchange, that doesn't matter who the lender is if it's not you. But if you're selling to your buyer, financing to your buyer as a taxpayer in an exchange, that note that's created, that indebtedness, is thought to be not like kind with real estate, and so IRS treats it like cash. And so at the closing, if the note goes directly to the taxpayer, that you receive the cash and you'll pay tax on it, either on installment method or however it does. And so if you do want to do a seller financing and you want to have the note go through the exchange, then you have the note written to the qualified intermediary. We would take the note, we'd hold it in a safe here in our office, and then you'd have to, as a taxpayer, have to find out some way to turn that note into real estate, either by getting the seller of the property you're buying to take the note, which is not that common to do, or you could have somebody else buy the note, or you could buy the note yourself, either at the beginning or at the end of the exchange. All those are kind of tricky situations, and so in general, we find our customers don't want to do that, but sometimes we do, and we can figure out how to deal with them when we can.
That's great to know. There's another one that came through here, Ryland. I want to have him see if he can help educate us on is reverse 1031 exchanges. I don't know much about a reverse 1031 exchange, Mike. So can you explain the rules for reverse exchange? And maybe share what it is first and then the rules.
Well, this always happens at the end, and it's a really complicated thing. So I'll try to do it justice both ways. The IRS wants you to sell first and buy second. But sometimes we need to buy first. So, and especially like in a market like we have today, you feel comfortable you can sell your property, but you don't know if you can find the property that you really want for the right price that you want to do. So what we often get is someone that says, I want to buy this property, have it in a contract, but I'm putting my property on the market. Can I buy first and sell second? And the answer is technically yes, but technically no, but effectively yes. The IRS has given us another safe harbor about reverse exchanges. And the typical process is this. We have to create an alternate buyer that's not related to you. Usually it's an LLC. The LLC goes to the closing and buys the new property for you and holds it using financing arranged by the taxpayer. And then that substitute buyer is called an exchange, accommodation title holder, an EAT. And this EAT buys the property and holds it. And then the rules allow the taxpayer who's arranging for this to spend 180 days up to 180 days to sell their relinquished property and then do an exchange into the property held by this EAT. And then, if we buy the property, the replacement property on day 1, say on day 50, we sell the relinquished property and we do an exchange. Then we can turn around and do an exchange and sell the property on day 50, use the cash, and go through the exchange account and into the new property, into the held property from the LLC on day 51, and we're done with the exchange. Now, that's the general process. It's complicated because we have to create LLCs. There's some liability that comes along with being the owner of a property, so we have to deal with that. There's sometimes, usually there's need to be a phase 1 for some kinds of properties, maybe not for residential properties. There's a how do we govern the property? We have to have a lease that has no rent. I mean, it's lots of stuff going on, but in general, it costs about 4 or 5 times more to do in a reverse exchange, but it solves some problems, and we do 8 or 9 of them a month. So there's more to it. I could talk for hours on that, but that's kind of a general process. Is you have a substitute buyer holds the property for up to 180 days while you work things out. This is a similar process to if you want to use exchange funds to improve the property you want to buy.
Very cool. Thanks, Mike.
Nice. Well, it looks like we have time for one last question. Let's go ahead with what's the tax rate on the boot?
Well, that changes. It's very specific to everybody. The tax rate that you pay is your capital gains tax rate, and people ask me, was it 15%? Well, 15% is probably a component, but everything that I do or you do affects our tax rate. And so if for high-income individuals above $450,000 for a married couple filing jointly, there's a 20% tax rate above that amount. You also have Medicare surcharge of 3.8% or 0.9% on top of that. So the tax rate is different for every state. In Utah, it's 5%. Wyoming, it's 0% for state tax. California, it's 9 to 13%. Some places there's a local tax, and so it ranges. But in general, I would say you ought to think about there's depreciation recapture at 25%. So it could be like in Utah, probably at least 20%, and it could be as high as 35%. And it changes based upon everything else that's going on in your life.
Interesting. Okay, awesome. Well, thank you so much. Those were really helpful answers. I hope that that kind of answered your guys' questions. Thank you so much for everyone for joining.
And Ryland, I'll say real quick, there's a lot more questions, and we could probably go on for another hour just answering questions. Ryland shared Mike's contact info and our contact info at the beginning. You're welcome to reach out, and we can go into more questions. And maybe we'll have Mike, if you're willing, maybe we'll have a 2.0 discussion at some point and go into some of these other topics. So
it's fun. I enjoy talking about my work, and I'm happy to do it. And so you have to stop me usually. So it's probably a good idea to stop after an hour, and we'll try again some other time.
That's awesome.
I think that sounds great. Awesome. Well, just parroting Nate, feel free to reach out to us if you need anything. And again, we'll be sending out a recording of this webinar. So for those of you who joined in late or may have missed it, we'll get that sent out to you guys so that you guys have a chance to review this. And yeah, we hope to see you guys next time, and hope you have an awesome day.
Thanks again, Mike.
Thank you.
Appreciate it. Thanks, Ryland.
Awesome.
Okay, see everybody.